A very good evening. My name is Nishit Kotak, and welcome to yet another session for the property professionals, where we bring you the latest information on the property market. Today, we have a very interesting day here in the UK with some changes in the some changes in the bank interest rate. And to walk us through this all, I will be joined by Akhil. Akhil Mair is the managing director at Our Mortage Broker Ltd. And Akhil's got an extensive experience in the UK banking industry, especially corporate finance, residential, and commercial mortgages since 2002. So Our Mortage Broker Ltd. Are an award-winning mortgage advisory firm, and they won the Best Buy-to-Let Broker in the UK award by Business Money Facts in 2023. Akhil, welcome to today's call.
Thank you for having me, Nishat. Thank you so much.
So, big day today. What has been the Bank of England's decision?
Well, it's a hot topic at the moment, and today's decision was a rate increase by 0.25%. It was voted by 7-2 in the favour of increasing interest rate to 4.5% now. That means we've had 12 consecutive rate rises. So we are now at 4.5% as of this afternoon.
That's the highest limit in quite a while, isn't it?
Yes, in over a decade now, that's been the highest interest rate we've seen. So for most of the first-time buyers or home movers in the last decade, I've never seen a rate change in the rate increase in their mortgages, nor in their payments. So what that means in short is if you are on a variable rate or a tracker rate mortgages, you can bet your bottom dollar next month your mortgage will be increased, but not for those that are on fixed rate mortgages for the moment.
So who and when does this affect again? It is when we talked about the borrowers, you talked about it may not affect people on fixed rate. It
Yes,
will definitely affect people on a tracker. But
correct.
what about those who are coming up for remortgages as well?
Perfect. So for those people that are watching or listening to this show, if you're on a fixed rate mortgage, you've probably got nothing to worry about because your rate is locked in for a particular amount of time. But what you need to be aware of is check when your mortgage is coming up for renewal, because it will be coming up for renewal in some time soon. The best thing to do is if you've got less than 6 months remaining on your fixed term mortgage, you should get in contact with us. We can look at the current lending market with the current lender and also give you options elsewhere in the market to ensure that you move on to a competitive rate rather than a bank standard variable rate when you come off the fixed rate. For those borrowers that are on a tracker rate mortgage or a variable rate mortgage, those will be hugely affected by the increase, and they have been so for the last 11 consecutive rises. So this is now the 12th. And what that means in short is, because the Bank of England's base rate has gone up, the cost of borrowing for those mortgages will certainly be going up as well, at least 0.25%, if not more. The banks can increase their mortgage rates by a quarter or more, or sometimes less, but you can bet your bottom dollar it will be at least 0.25% increase, usually from the first of the next month.
Fabulous. Well, with every change in the market, we have some winners and some losers.
Yes.
So what's the latest shakeup from this rate change? Who are the winners and who are the losers?
That's a great question. So the winners are going to be people that are saving money, the savers out there. So people that have got cash deposits in their banks or their building societies, they will hopefully see the interest rate that they're receiving on their cash deposits increasing, which is a nice position to be in, albeit that we've had very low rates of interest for savers over the last decade or so. So they're going to be the winners. The losers, unfortunately, are going to be those, as I said, that are on variable rate and tracker rate mortgages, and also potentially those that are looking to take out a new mortgage, for example, first-time buyers in the coming weeks and months. So they're going to be potentially the losers out of this increase, this recent rate increase.
So, I mean, you got your finger on the pulse of what's happening in the market. What's been the reaction of the market to today's announcement?
Well, listen, it's 12 consecutive increases. I think everyone's getting used to every month or so we're going to have rate increases. So the stock market had already factored in 0.25% rate rise because of the consumer price index that came out a few weeks ago. So they certainly priced that in. Lenders themselves have already priced that into their product guides that they're offering their clients. So it's not a surprise, which can be a good thing and can be a bad thing. The key financial data that we all need to be looking at is inflation. Where is inflation heading? What are the swap rates looking like? And what are the other global factors implementing across the world? So we've got a lot of chaos at the moment around the world, whether it's financially or in the war or energy prices. So they're playing a huge fundamental on where interest rates are being set for the short and medium term.
Well, this kind of a change is certainly going to hit people, directly in their pockets. And
Yes.
Mortgages are sometimes, I would say, probably for majority of the people, is the biggest single monthly outgoing on a regular basis. So what should borrowers start doing to sort of spare themselves from the extra, volatility in their bottom line?
Well, I think that you hit the nail on the head. As you said, usually the biggest direct debit on anybody's bank statement is their mortgage payment, unless they've got a flashy Ferrari or a Lamborghini coming out as per direct debit. But jokes aside, on a serious note, yes, mortgages are usually your biggest ticket on your bank statement. As I said, if you're tied into your fixed rate, just make sure you set an alert on your Apple phone or your calendar or whatever you want to alert you at least 6 months in advance of your fixed rate mortgages ending. Again, you don't need to wait for 6 months ending. The team at our mortgage broker are certainly willing to support and guide any client that is looking to get a new mortgage coming out in the very near future or so, i.e. in the next 12 months, or they've got mortgages coming up, and that could be for their main residence, that could be a buy-to-let mortgage, or any other mortgages in particular. So again, it doesn't need to be just for your main residence, it can be for buy-to-lets. And for people out there that have got large portfolios, they can become quite forgetful if their admin is not straight. And we always recommend is share the portfolio with us. We'll remind the client in advance so that they don't go onto those high standard variable rates, which the banks are setting at the moment.
So there are going to be various kinds of mortgage clients you will be meeting on a regular basis. Buy-to-let, you mentioned, first-time buyers, and a variety of people dealing with HMOs and various different things, commercial mortgages and various things. What kind of mortgage clients does today's rate hike affect most?
So most of them are going to be the residential mortgages, so residential and buy-to-let mortgages. But again, for those borrowers that have got commercial mortgages, either they're owner-occupied commercial or even in commercial investment mortgages, they're usually linked, i.e. they're usually variable rate. So it's a base plus a margin that the bank sets in advance of the loan. So anybody that has a mortgage in the UK, whether it's residential or commercial, will be affected, especially those that are on variable and tracker rate mortgages.
So I've seen a case where, for example, the rent cannot be increased so much, but the mortgage rates have gone up, and then the difference for a buy-to-let landlord is very little sometimes, or sometimes even negative for them.
Yes.
So I've heard that from a few of my friends that they had to sort of get rid of some of their buy-to-lets because it was not profitable anymore due to the rate increase.
Yeah, you're totally right, Nisha. We've had over a 400% increase of rates in the last 12 months. Nobody expected it. Some did, some didn't. But we are where we are now. We speak to most of our clients are buy-to-let seasoned investors. The conversations we're having with our clients is you need to look very closely to the numbers. What properties are actually making you a genuine profit, net profit, and which ones are not? Are we considering selling off a couple of the properties to reduce the loan to value across your portfolio potentially? Or is there ways that you haven't done any rent reviews? Have you done any rent reviews in the last 12, 24, 36 months? Are you receiving the market rent in today's market? So where house prices are stabilizing, or in some parts of the country, they're coming down a tad, rents are actually going up. So supply and demand from that perspective is it's positive for the landlord and negative for the tenant. So a lot of our landlords haven't actually increased rents over the last decade or so, simply because the surplus net cash flow was enough for them. When it comes to renewing those mortgages now, the lender will ask what rent is being received versus the actual market rent, and they will go on the lower of if their rent received is lower than the actual market rent. So there's lots of variables that go in take into account. It's not to say that they can't use the market rent. They can potentially use the market rent, sorry, rather than the rent being received. But again, that's a conversation to be had on individual cases. So I would suggest is if you haven't done a rent review, make sure you're doing that. Analyze the numbers, the net cash flow from each of the properties, because cash is king and cash flow is even more of a king in the property space. Capital growth and capital value growth are more of a long-term view. That's the way I look at it. But if it's not cash flowing positively, especially in today's market, then you need to consider rent reviews. How can I add value to the property to increase the rent, perhaps moving from a single family let to a HMO, you could consider that option to increase the yield for that property.
Fabulous. So, I mean, there's loads going on at the moment, and certainly I'm sure people who had a good run in the property industry for years where there was little to no movement in the interest rate, I'm sure they've been taken by surprise by this 12 consecutive rate hikes. What, according to you, is the prediction for the interest rates in the next couple of months going into 2023?
So my prediction has always been very bullish, unfortunately, over the last 2 years. I've done many videos with many other channels in the UK, and I predicted 2 years ago that interest rates will be where they are now. And I hate to say it, but I still think interest rates have got some way to go up, unfortunately, before they do come down. So we are in 2023. We've got another 6 or 7 months left of the year. My prediction is we'll be at 5.5% by the time we eat our Christmas turkeys, unfortunately, in December. So that's 5.5%, I believe, by the end of this year. I think we will see interest rates come down. I don't think they'll be as quick as everyone expects. I think it is very much dependent on the external variables which are outside the UK's control. Inflation pressures are certainly there, and I was driving past the local petrol station earlier today, and fuel prices have come down to £1.60 for a diesel, whereas 6 months ago they were near £2 a litre. Yeah. So you can see a 25% or so discount on your petrol prices there. Unfortunately, food prices are certainly not coming down at that level. They're actually increasing, which is actually playing a negative effect on inflation. So I don't think inflation will come down as quick as everyone expects in 2023. I still think interest rates will certainly go up. But what I am optimistic about is inflation will come down to about 5 or 6%. But I don't think that'll be this year. I think that'll be the tail end of 2024. Where interest rates lie and where most of us take our borrowing from, the UK's interest rate on average is usually between 4 and 5%. That's where we are now. So it's not the new norm, it's just the regular norm that we've always had pre-2008. So these are the average Bank of England interest rates that we've always had in the UK. So my view is rather than being complacent or thinking half full, we should actually think half empty and say, you know what can we do to increase our yields, to be a bit more focused around the numbers? Where are we actually adding value and where are we actually wasting time? So I think it's pivotal that us as advisors, amongst our power team of property professionals, we keep an open dialogue with all our clients and vice versa, and actually be open and honest about how we're going to grow as a business together with our clients and be more and more prosperous in the property space.
Fabulous. Now, digging a little deeper into inflation, how is it really doing at the moment? And is there any hope for the government to meet its 2% target in 2023? Judging from what you've said, I think that's blown out of the water.
Yeah, I think, unfortunately, a 2% target is a nice target to have. But when we're at circa 10 or 11%, or the official rate is 10 or 11, some might argue it's 15 or 16%, but that's another conversation for another day. But I don't think we're going to get from 10 to 2% in the next 6-7 months, that's for sure. Unfortunately, as I said, there are external pressures that are taking precedent over the others. I think what we need to be more conservative and more concentrated on is our internal inflation as family and homeowners. What can we control in our own capacity? Where can we cut our costs? Where can we reduce our costs? What can we save on? What can we reduce our overheads on? And that comes down to basically old school banking, pen and paper and a calculator. I don't think there's no point reproducing any wheel here. I think common sense lending, common sense approach, but with an optimistic view that there is light at the end of the tunnel. It's just a matter of going through the barriers to get to the other end.
Fabulous. So now this looks like a very challenging landscape to navigate. What are the benefits of using a mortgage broker?
Well, there's loads. There are so many benefits. You know, the ones that really stand out for me is, number one, the mortgage market is extremely complex in terms of criteria, rates, options, parameters for the borrower, the parameters on the property types, the parameters on the loan to value. So where the mortgage broker certainly adds value, and the most important one is being holistic, being transparent, and providing a whole of market advice. Now, what I would say is a lot of it's key that anybody that speaks to a mortgage broker has an open and honest conversation with that broker to understand, are they genuinely whole of market, and do they genuinely have access to every single lender in the market? And I'm proud to announce we are a team of 10 mortgage advisors, all fully qualified. Our clients can visit us at any of our two offices. One is in Bracknell in Berkshire, quite close to Windsor Castle, and the other one is in Mayfair in London. So our clients can see us face to face, but more importantly, we genuinely have access and direct access to every single lender in the UK, including HSBC, Bank of Ireland, HSBC, Bank of Ireland, and TSB. So we are genuinely whole of market, we are genuinely independent, and we are directly authorized by the FCA. So that's paramount that they use a whole of market mortgage advisory firm. Number two, we save the client's time. Time you can't put money on. There are tons and tons of lenders and banks in this market. There are thousands of mortgage products. To get an appointment with any bank will take you days and weeks, whereas we're going to scour the entire mortgage market, shortlist the relevant lenders based on rates, affordability, and stress testing, and then we'll present that information. So time, you can never put a price on, so we'll save the client time. And having access where we have access to every single lender in the market, they're my top two. The third thing is we're good at what we do. So we leave our clients, the borrowers, to do what they do for a living. They specialize in whatever arena they are in. They leave us to the rest. So it's we take care of the finance for them. All they've got to take care of is providing us with the information that we require.
Wonderful. Now, I do want to recap the whole thing. If I ask you some questions in a rapid fire style.
Sure.
So just for the viewers out there to get a good grip on what subject matter we're talking about. So folks, if you've just joined us recently, we are talking to Akhil Mair, is the Managing Director of Mortage Broker Ltd. And we are discussing today's interest rate hikes by the Bank of England and how it's going to impact the mortgage market. So Akhil, so here's the first question for you. Yeah. Can you explain how the recent interest rate hike impacts the average market mortgage holder?
So the vast majority won't be affected by today's decision because most of the mortgage borrowers are on fixed rate mortgages. For those that are on variable rate and tracker rate mortgages, be warned, the likelihood that your mortgage payment will increase from the 1st of June or thereabouts will certainly happen. Speak directly to your mortgage lender for that decision.
So now, a couple of, say, just maybe 2 years back, the mortgage rates were very different. Today is very different. So how does this latest interest rate hike affect first-time buyers who are looking to enter the market?
Yeah, so let's look at the negatives first. First of all, your payments are going to be a lot higher than they would have been 12 or 13 months ago. So let's get the obvious one out of the way. More importantly, the positives are this. There are many lenders out there to help first-time buyers to get on the ladder, first and foremost. Their rule of thumb of 4 or 5 times annual income is no longer there. It's all done on an affordability basis. There are lenders, however, do promote 5 times borrowing, 6 times borrowing, 7 times borrowing, but that's all done on an individual basis. My opinion and my approach is very simple. You tell us your scenario, we'll ask you the questions, and we'll hopefully get you where you want to be. If we can't help you get to where you want to be today, what we can do is we can create a timeline for you to do step 1, step 2, step 3, and then we can get to where you want to be in the short or not too distant future.
Super. So is there a typical lag time between when an interest rate hike happens and when the mortgage rates follow? And if so, how long is it typically?
Good. So we've had the interest rate increase today, 12th of May. The next Bank of England decision meeting is on the 22nd of June. So between now and then, banks will consider increasing their interest rates for their existing clients, as well as any new mortgages that they take out. The lag between the decision and the rate increase can happen same day, next day, or the subsequent day. It depends on the bank's appetite. But as I said earlier, the market was expecting a quarter of a rate increase. The banks obviously thought the same too. So they would have factored this in. As mortgage brokers, another benefit of using a directly authorized brokerage and an independent one is we usually get a heads up a day or so in advance of any changes to any mortgage rates with any particular lenders. So that helps us manage expectations and help the client get the cheaper rate rather than applying tomorrow and getting a slightly expensive rate.
Super. Here's another recap question. So what advice would you have for people who are currently looking to remortgage their properties in light of the rate increase?
Perfect. So I think the key ones here is make sure that you've got all your admin lined up. So valid passport, valid driving license, pay slips, bank statements. Check your credit report. A lot of clients are not aware of any adverse on their credit report. It's not to say they have got it or haven't got it, but sometimes we don't keep a close eye on credit rating, credit scores. Log on to someone like checkmyfile.com. Few questions, you get your credit report emailed to you. Just do a sense check on it. Make sure that any open accounts that you have, any open credit lines that you have are relevant and they are precise. They are related to you particularly, and there's no fraudulent activity taking place in the background that you're not aware of. So that's the admin side of it all. As I said, whether you're looking to buy a property in the next month, 3 months, or 6 months, get in touch with us now. Let's start talking about the process. Let's talk about the timelines. Let's talk about what's involved, what costs look like, so you can then go away confidently, start talking to the estate agents and start doing the viewings, and you can know that the mortgage is virtually taken care of. Now it's just playing the part of looking for your next home or the next buy-to-let purchase.
So it seems to me this is now turning into a buyer's market.
Yes.
Because of the rate increases and the affordability requirements now, access to mortgages.
Yeah.
How do you expect this mortgage rate increase or interest rate increase to impact the UK housing market as a whole?
It's a very good question. So we've definitely seen a slow uptake on the buying and selling space, and that's simply because of the current interest rate market. It's a bit volatile. We've had 12 consecutive rises now. So where we were 12 to 36 months prior, where things were going on the market, they were selling over the odds immediately, that has certainly slowed down in the last 3 to 6 months. But what's happened here is, you're right, we've gone from a seller's market now certainly to a buyer's market. And what that means to the buyer is now it's time to negotiate. If something's on for 500,000, I would not many estate agents probably like this, but I would start the bidding off at 400,000, because every property is only valued at what the person is willing to prepare to buy it for. You know, the agent or the seller may think it's worth 500, but my affordability and my research and due diligence on that property and in that environment, I might only think it's worth 400. I always say there is no such thing as a silly offer nor a question. If you don't put it in, you'll never ask. So there's certainly a negotiation to be had. I think those that are in a position where they have nothing to sell, they're chain free, that plays a huge advantage. Another big advantage is speaking to a mortgage brokerage like ourselves, where we can provide the clients with a decision in principle certificate. And that shows to the agent that the borrower or the new purchaser has now started the ball rolling with a mortgage perspective. They've got a solicitor on the side. They've got the mortgage advisory firm on the side. Agents like that because they take you more seriously. You'll have access immediately to the property to view it, and your offers will be taken more seriously. So I'll certainly believe that negotiation right now is in a buyer's favor.
Super. So from a mortgage broker's perspective, what are the potential upsides to an interest rate hike?
The uptakes, for us, the mortgage is the mortgage, right? We can't dictate, we can't ask the mortgage lender to give any discounts. What we do here is, yes, the rates have gone up, but where we play an advantage is looking at different ways of reducing your monthly payments. And that might be because we can increase the loan term for that period of time to reduce the monthly costs. And that plays quite a pivotal part in a high interest rate market where affordability can sometimes be low. Is stretch the term out to reduce your monthly payments, But and the plus side is most lenders offer you an overpayment facility, usually typically 10% of the loan amount, where you can overpay your mortgage ad hoc, monthly, weekly, or yearly, to reduce the interest costs down.
Fabulous. So let's debate a little bit on the potential for future interest rate hikes and how consumers can prepare for this eventuality, because you predict it will still go up to 5 point something by December, right?
Yes.
Okay.
Well, you know, everyone's got their own crystal mazes, crystal balls, and all this sort of stuff. I always say is think of the worst case scenario. My worst case is 5.5% by December. I believe it will be. Yeah, whether it is or whether it's not, we're heading in that direction. All I would say is start lining up your ducks now. Look at all the opportunities that are out there. If you're looking to purchase your next home or a buy-to-let, negotiate the price. Where you add value, where the value is on day one, the purchase price. The next stage is how can you add value to that property in the most efficient and cost-saving manner to increase the value. And by doing so, then you've added value to the property, and then there's a potential uptakes where we can refinance that property at the new uplift value in order for you to take some money out. And that's also known as the BRRRR strategy. So you buy it, you refurb it, and then you refinance it at the uplift value, and then you repeat that cycle again. That's very typically done on the buy-to-let arena, not so much on your main residence. But again, you know, buying low, buying at the right price, finding ways you can add value to the property, i.e. your home, still adds future value when you want to go and sell it potentially, or when it comes to refinancing it in 2 or 5 years' time, for example, your loan to value would have come down.
So would you recommend this strategy to people who are looking to sell at this time to add a little bit of value to their property before they put it onto the market?
Yeah, I think if you're in the market of selling, you know, you've certainly had a good time in the property market in terms of interest rates have been low, the yields have been amazing for you. I would say is leave some money on the table for the next buyer, potentially, and sell those opportunities to the next buyer, simply because there's not so many properties coming onto the market. And if you are keen to sell the property, you've got to sell all the advantages and all the upgrades that you've done to the property, but also inform them that there is potential and upside to extend it out this way, and so on and so on. So leave a little bit of value add for the new buyer to purchase it. That'll give them more of an incentive to buy it. And I think there'll be a bit more openness.
Yeah, I suppose then they are able to do it up the way they want it, rather than getting something you've done in your own way.
I agree. I totally agree.
Wonderful. Now, when it comes to mortgage products, there will be a range of mortgage products, and some may be more or less appealing to people because of the higher interest rates. So, for example, fixed rate mortgages will become more popular because there's a certainty in the repayments.
Yes.
However, there's also the flip side, which is somebody is fixing for 2 years at a higher interest rate, like potentially 5 point something, when they could have just been on a tracker, and then hopefully by a year or two, it's come down to again 2 point something, and they save in the longer term. What would you recommend to people who are like, you know, thinking about this kind of a thing?
Yeah, that's a good question. So for those that opt for the fixed rate mortgages, yes, it gives you certainty for that 24 or 60 months or anything like that. But what happens here is you're paying for the certainty. So when you're going for a fixed rate mortgage, you're actually paying over the odds, but you're getting the certainty that, you know, you can close your eyes for the next 24 months. Nothing will change for your payments. Whereas if you're an entrepreneur and you're hedging your bets and you believe in the next months or years to come, interest rates will come down, then you may want to potentially look at a 2-year tracker rate mortgage or the alike, where you're going to hedge your bets for the shorter period of time, and your payments will be coming down in that period of time as well. So I think it depends on how entrepreneurial you are. What's your research look like? What's your experience in that market? And if things do turn worse, what means do you have to ensure that you're covered for those mortgage payments? Or can you switch to a fixed rate mortgage with that same lender or go elsewhere? So it's very common in a high interest rate market, people like short-term fixes or tracker rate mortgages. In a low interest rate market, people tie in for a longer period for obvious reasons. I don't think there is any right or wrong, to be honest with you. I think the only right thing to do is, if you know you're going to buy something for 100,000, you're going to add value to it and it's going to be worth 400,000, then you've got to consider short-term mortgages, tracker rate mortgages, or more importantly, mortgages with no early repayment charges, so you can exit that mortgage without penalty and go again. Whereas if you're tying yourself into a fixed rate mortgage, the only way you can come out of that mortgage early within that fixed period of time will be to redeem that mortgage, but by also be paying a penalty to come out of that mortgage. So in short, there is no right or wrong. I think it's all done on a deal by deal basis, as well as where the client sees his own risk appetite in the short to medium term.
Wonderful. So folks, we've been in conversation with Akhil Mair, Managing Director at our Mortage Broker Ltd, an award-winning mortgage brokerage firm with, you say 10 members on your team, right, Akhil?
That's right. Yes, so we're a 10-man business and lady business, I should say.
So where can somebody connect with you, and when should they connect with you?
Thank you. Yeah, so we're fully accessible 7 days a week. As I said, we've got 10 qualified mortgage and property finance advisors at the OMB business. So people can connect with us by telephone, email, social media channels, and by visiting our website, ourmortagebroker.co.uk. Contact us by any of those means. We'll be happy to help you. There is no cost to any of our conversations with our clients. We're here to help and support our clients in the best way forward. As I said, telephone, email, social media, or directly through our website. We'll be happy to support anybody.
Thank you, Akhil, for joining us today. So viewers, I would like to remind you, you're watching a live stream broadcasted from the Property Professionals. We are an online group that helps people in the property industry to come together, network, and learn more about how they can make the best of their journey in the property industry. So to summarize today's discussion, we were focusing on looking at the interest rate hike from the Bank of England today and how it will impact the mortgage rates coming in the very short term. Akhil said this could be as soon as tomorrow or the week after, when people will start seeing the impact of this rate hike. So we discussed a range of potential questions and talking points over this interview, including questions about the impact of this interest rate hike on various parties, including existing mortgage holders, first-time buyers, and even those looking to remortgage. We also considered how interest rate changes might affect different types of mortgages and the broader housing market in the UK. We covered various other themes on the same topic, including buy-to-let market, the relationship between inflation and interest rates. We looked at the potential strategies for consumers to navigate these changes that are happening in this market. Additional questions then we discussed and expanded upon, including benefits for savers and investors, the impact of refinancing market. We looked at strategies for future home buyers. We looked at the concept of rate lock and the impact on the various forms of borrowing and the potential risks and rewards of adjustable rate mortgages. So we also looked at external factors from the UK, things like the global economy. We touched on various other things. So the long and short of this is, from what Akhil has mentioned, is that we are in this for a little while longer. Certainly it's going to go a little higher based on his predictions. And then after that, we're looking at maybe in 2024, a little cooling off of the interest rate in the UK. Akhil, as always, it's been wonderful to have you here on our show, and we look forward to catching up with you on the next show. Do you have any last parting words for our viewers?
No, thank you so much, Nishit, for a lovely debate or a conversation around interest rates. Sorry, I couldn't bring any better and more great news if we had a rate decrease. But again, with any decision, there's always winners and losers. What I would say to anybody out there, it's good to talk. Give us a call, drop us an email, and we'll be delighted to support and try to guide anybody going forward. But you know, property is a great space. You know, as UK individuals, residents, property is a great asset class. If you look at property as a long game, there's lots of gains to be had over a medium to long term future. But we live in a great environment where we've got access to information and education with only a few clicks away. Again, speaking to the right people and having a good power team around us is key and pivotal in any business. And I think property is a great industry as an investment strategy for the medium to long term.
Fabulous. Akhil, thanks so much. And we'll catch you on the next